For more than a decade, the UK economy has felt like it's moving, but going nowhere. Jobs exist. Markets function. The system hasn't collapsed, and yet, wages barely rise. Productivity refuses to recover. Living standards feel frozen in time. This creates a strange contradiction. If nothing is breaking, why does nothing improve? The answer isn't simple, and it isn't political. It's structural, and it's been building quietly for years. To understand why the UK economy is stuck, we have to look at what it became before it stopped moving. For decades, Britain relied on a very specific model. It didn't compete on mass manufacturing. It didn't chase scale like the US or Germany. Instead, it specialized: finance, professional services, real estate, global capital flows. London became a financial engine not because Britain produced more, but because it connected others. Money moved through the UK. Talent moved through the UK. Decisions were priced in the UK. This model worked extraordinarily, while during the rise phase, capital flowed in faster than productivity needed to grow. Asset prices rose faster than wages. Consumption stayed strong even as investment weakened. Growth came from valuation, not expansion. But that model had a hidden dependency. It required constant confidence. Confidence from global investors. Confidence from businesses. Confidence that Britain would remain frictionless, predictable, and connected. That confidence slowly eroded. The breaking point wasn't one event, it was accumulation. Underinvestment in infrastructure. Weak productivity growth. Rising housing costs absorbing income. When shocks arrived, the system had no buffer. The global financial crisis exposed how dependent the UK had become on finance. Brexit reduced access and certainty. The pandemic amplified existing weaknesses. Each shock didn't break the economy, it locked it in place. The fallout looks subtle, but it's everywhere. Businesses invest less not because they're pessimistic, but because returns look unclear. Workers switch jobs, but wages don't rise meaningfully. Government spending increases, but productivity doesn't follow. The economy survives, but doesn't accelerate. This is the danger of a stuck system. It adapts just enough to avoid collapse, but never enough to regain momentum. Policy responses tried to restart growth. Interest rates were cut to historic lows. Fiscal stimulus came and went. Tax changes were announced and reversed. But these fixes misunderstood the problem. The UK doesn't suffer from a lack of demand. It suffers from a lack of productive expansion. Too much capital flows into housing instead of industry. Too much talent clusters in services with limited scalability. Too little investment goes into long-term capacity. Housing becomes the economy's absorber. Rising prices mask stagnation. Debt replaces income growth. Wealth inequality widens quietly. This pattern repeats globally, but hits the UK harder. Because when finance dominates without growth underneath, stagnation becomes stable. Modern data reflects this clearly. UK productivity lags behind comparable economies. Business investment remains weak. Real wages trail inflation over long periods. The system isn't failing. It's idling. History shows this isn't new. Countries that rely heavily on asset inflation eventually hit limits. Once prices outrun incomes, growth slows. Once investment delays become normal, recovery weakens. Japan experienced this earlier, parts of Europe followed. The UK joined without realizing it. Failed fixes followed predictable patterns. Short-term stimulus instead of long-term planning. Housing incentives instead of supply reform. Political resets instead of structural change. Each fix stabilized sentiment. None unlocked growth. Because growth requires risk, and the system rewards safety. Banks prefer property lending. Investors prefer assets over expansion. Governments prefer stability over disruption. The economy becomes optimized for preservation, not progress. 3 conclusions stand out. First, an economy can function perfectly and still go nowhere. Stability is not growth. Second, asset-driven prosperity eventually crowds out productivity. When prices rise faster than output, momentum disappears. Third, stagnation is hardest to reverse because it feels manageable. There's no urgency until time has passed. The real question isn't whether the UK can recover. It's whether it's willing to change what it rewards. Because economies don't get stuck by accident. They get stuck by design. If you want to understand why modern economies slow down without collapsing, and how hidden incentives shape outcomes, subscribe to the channel. Because the most important economic problems aren't loud, they're quiet. And by the time they're obvious, they've already been there for years.